Hey everybody, we're waiting for a couple more stragglers, but I think we should get started. So welcome everybody to this presentation on how insurance fits into your financial plan. Insurance plays a crucial role in a comprehensive financial plan by providing protection against unforeseen risks and helping individuals and families safeguard their financial well-being. Today, we are going to go over the most common types of insurance available. We'll touch on different types of insurance, and we will take a closer look at life insurance as part of your financial plan. I hope that when we're finished, you'll have a better understanding of how it fits in and why I'm always talking about it. Before choosing a life insurance policy in Canada, it's essential to carefully consider your financial situation, long-term goals, and the needs of your dependents. Consulting with a licensed advisor like me can help you understand your options and make an informed decision. So here's how life insurance fits into a financial plan. Life insurance provides a payout when you pass away. Living benefits cover events that happen while you are still alive. All of these options cover the following. Risk management. Insurance is a fundamental component of risk management and financial planning. It helps cover various risks that would impact an individual's finances, such as premature death, disability, illness, property damage, liability claims, and loss of income. By transferring these risks to an insurance company in exchange for paying a premium, individuals can protect themselves and their families from financial losses. Income replacement. Life insurance, particularly term insurance, can serve as a tool for income replacement in the event of the policyholder's death. The death benefit provided by a life insurance policy can help replace lost income, cover ongoing living expenses, pay off debts, and maintain the standard of living for the surviving family members. Debt repayment. Life insurance can also be used to repay outstanding debts, such as mortgages, loans, credit card balances, or business debt, ensuring that these financial obligations do not become a burden on the people left behind. Estate planning. Life insurance plays a vital role in estate planning by providing liquidity to cover estate taxes, final expenses, and other settlement costs. It can help preserve assets and ensure that your heirs receive their intended inheritances without the need to sell off assets or deplete savings. Education funding. Parents can use life insurance to fund their children's education expenses in the event of their premature death. A life insurance policy can provide a source of funds to cover tuition, fees, books, and other educational costs, ensuring that children can pursue their academic goals even if their parents are no longer around. Business continuity. Insurance is essential for business owners to protect their enterprises against various risks. These life insurance issues include things like business interruption, key person loss, and living benefits would cover employee benefits. Business insurance policies such as commercial property insurance, general liability insurance, business interruption insurance, and key person insurance can help mitigate these risks and ensure the continuity of your business operations. In summary, insurance is an integral part of a well-rounded financial plan, providing protection, security, and peace of mind against various risks and uncertainties that can impact an individual's financial stability and future goals. By incorporating these expenses into your financial planning process, individuals can effectively manage risks, protect their assets, and achieve their long-term financial goals. The last two that we are talking about here are healthcare funding and long-term care, and we will look at them further in a slide that's coming up. So what holds us back? Why wouldn't you want to buy insurance? Well, there are lots of reasons. that may contribute to people's objections to looking at and paying for life insurance. I think the biggest one I hear about is that people think that life insurance or living benefits are going to be expensive. They feel like maybe the premium as an additional expense that adds to your monthly financial obligations is just too much. People may prioritize other financial goals or expenses over purchasing life insurance, especially if they expect it's going to be expensive. The lack of an immediate benefit. This is one I hear too. Unlike other types of insurance, such as health or auto insurance, where policyholders may directly benefit from coverage through healthcare services or vehicle repairs, life insurance provides a benefit that the person who's paying for it will never see. This lack of immediate benefit may deter some individuals from seeing the value in paying premiums for life insurance. Risk perception. People may underestimate the likelihood of experiencing premature death or believe they are not at risk, especially if they're young, healthy, or do not have dependents. As a result, they may perceive life insurance as unnecessary or irrelevant in their current circumstances. This rings even truer with living benefits. People may not believe that you can have a heart attack in your 30s or 40s and may feel like they have a very low risk of things like cancer or stroke. Complexity and confusion. This is the one I hope to try and fix a little bit today. Understanding the various types of life insurance and living benefits with coverage options and policy features and terminology can be overwhelming for anyone who's not familiar with insurance products. The complexity and confusion surrounding life insurance may discourage some people from exploring their options or making informed decisions. Trust concerns. People don't always trust insurance companies. I know you're shocked to hear this, but people are often skeptical and reluctant when they're looking at purchasing different kinds of insurance. Some people may even hesitate to enter into a financial contract with an insurer due to concerns about claims processing, policy terms, hidden fees, or the financial stability of the insurance company. This is something that can be really helped by talking to somebody you trust. Shorter term financial priorities. I feel like this one has really increased over the last little while. People facing immediate financial challenges or competing financial goals, such as paying off debts, saving for a home, covering the cost of groceries, covering the cost of gas right now, just may not feel like they have the money to enter into a long-term financial contract with an insurance company. These priorities are important, and they don't want to make a commitment that they're just going to have to cancel if things get tough. An overestimation of employer coverage. Lots of us have insurance where we are covered by our employers while we're working. The issue with group benefits is that people may overestimate the adequacy of this coverage or assume it provides sufficient protection for their needs. However, employer-sponsored coverage often offers limited coverage amounts and may not fully meet your needs, especially if you have children or significant financial obligations. And the last one is fear of death, fear of mortality. Discussions about life insurance can trigger some uncomfortable thoughts or fears about mortality, leading individuals to avoid addressing their insurance needs or planning for the future. Denial or avoidance of death-related topics may contribute to resistance towards purchasing insurance. This is totally normal. As we go through it, I'm often talking about how this is just going to be an uncomfortable conversation, and we're just going to have to deal with it. Addressing what holds us back from paying for insurance requires education, awareness, and personalized financial planning. By providing clear information about the benefits of life insurance, addressing misconceptions, and helping you understand how life insurance fits into your overall financial strategy, we can overcome concerns and discomfort and encourage informed decision-making. Additionally, working together, I can provide guidance and support in selecting the right life insurance coverage based on individual needs and circumstances. So let's talk a little bit about the different kinds of insurance. We are going to talk about the different kinds of life insurance policies available and some fundamentals about living benefits. So when you hear me talk about insurance, you normally hear me talk about temporary or term insurance and permanent insurance. Term life insurance, which we hear about a lot, covers things like paying back your creditors, being joint on a life insurance policy with someone else. What in the world is convertible and non-convertible and renewable insurances? This is the most straightforward kind of life insurance. It provides coverage for a specific term, typically ranging from 10 to 30 years. If the policyholder dies during the term, the beneficiary receives the death benefit. However, if the policyholder survives the term, the coverage ends and there's no payout. Term life insurance tends to be more affordable compared to other types of insurance, especially for younger individuals, and can be used as a great tool to cover off while you don't have the money to cover other expenses. Creditor insurance is insurance offered by lenders. So this is sometimes called mortgage insurance. It's offered to cover outstanding debts. The policy pays out to the institution. So if you have insurance on your mortgage, it would pay your lender, not your beneficiaries. And it will pay out the outstanding amount only that you owe, nothing further. The policy ensures that it does not become a burden on your estate or your family if you do pass away before you've paid back that debt. Joint life insurance is pretty simple. It covers two individuals, normally family members, could be business partners, under one single policy, but the death benefit only pays out once. So it's important to understand whether or not joint life insurance or multi-life insurance is right for you. Term to permanent convertible coverage. Some term life insurance policies offer the option to convert to a permanent life insurance policy without the need for a medical exam. This can be beneficial if the policyholder's needs change over time and they want to maintain coverage beyond the term of the insurance policy. Not all policies are equal, so it's important to know what options are available to you. Renewable insurance as well is only available within some policies. Some term insurance guarantees that you will be able to renew it without any questions about your health or lifestyle. And it's important to know all these differences when choosing a policy. So let's go on to permanent life insurance. Just like in term insurance, you can buy a joint permanent life insurance policy. However, often when we're talking about joint permanent insurance, there is a specific use and they only need one payout. Whole life insurance. This type of insurance provides coverage for the entire life of the policyholder, as long as premiums are paid. It also includes a cash value component that grows over time, which can be accessed by the policyholder through loans or withdrawals. Whole life insurance also typically has a fixed premium, so you know what the cost will be. Universal life insurance. Universal life insurance offers more flexibility compared to whole life insurance. Policyholders can adjust their premiums and death benefits within certain limits. Like whole life insurance, universal life insurance policies also accumulate cash value over time. However, the policy details are a little more complex, and we'll get into that in a minute. Term to 100. Term to 100 kind of straddles both. This insurance provides a straightforward and cost-effective way to obtain permanent life insurance coverage in Canada. It can be a suitable option for individuals who want to ensure that their loved ones are financially protected, but don't care about the complexities of cash value accumulation or investments. It often has a level cost, and it will stay in force for your entire life as long as you pay your premiums. As we go along, if you do have any questions, please enter them in the chat and I will answer them at the end of the presentation because I don't have a co-host today. living benefits. So if we were to look back at what we saw in that second slide, we're looking at insurance that is designed to pay out while you're still alive. These options are part of risk management for income replacement, preserving your savings, and keeping your financial plan in place while you deal with unexpected illness or injury. The first one on this list is critical illness insurance. And as it sounds, it pays out if you have a critical event, such as a heart attack or stroke. It also covers things like organ transplant, developing degenerative disease like Parkinson's, and depending on the policy, can cover up to 26 different conditions. This policy pays out as a lump sum when you're diagnosed. Most policies have a 30-day waiting period. All you have to do is live those 30 days and it will pay out. Premiums for critical illness insurance are typically based on factors such as age and health of the policyholder, as well as the amount of coverage and the length of the policy term. The lump sum payment for critical illness insurance is usually tax-free, and you do not have to prove that you can't go back to work for you to qualify. You just have to prove that you have had this event. Disability insurance. I think this is probably the kind of insurance that we're most familiar with. When we think about disability insurance, it provides some income replacement if you become unable to work. It requires that you have stated your income, proved your insurability, so usually gone through some kind of a medical, unless it's provided by your employer. And it is split up into short and long-term disability when we're talking about coverage that's provided by your employer. Once you have transitioned to long-term disability, where you have a disability or an inability to work that is going to last for an extended period, you will have to go through a variety of different questionnaires, seeing your doctor, etc. However, it does provide you with income replacement. If you have a personally owned disability policy, that policy may run until your retirement age. Normally, disability pays out tax-free as well. However, you have to make sure that you're paying for it with after-tax dollars. Some disability policies offer coverage tailored to specific occupations, such as physicians, lawyers, or tradespeople. These policies may have specialized features and benefits designed to meet the unique needs of the individuals in these professions, but every policy is different. I added travel insurance in here because I don't know that we talk enough about this. Travel insurance provides coverage for unexpected events that may occur while you're traveling in Canada or abroad. Travel insurance policies can be purchased for single trips or as an annual multi-trip policy, which provide coverage for multiple trips within a year. As well as medical emergencies, it may cover lost baggage, trip delays, cancellations or interruptions, and accidental death or dismemberment while you are away. Healthcare coverage. So this is one of our main boxes that we saw in those first slides. Health insurance is critical for managing healthcare costs and protecting against medical expenses resulting from illness, injury, or disability. Health insurance policies cover various healthcare services, including hospitalization, medical treatments, prescription drugs, and preventative care, reducing out-of-pocket expenses and providing access to quality healthcare services. Here in Canada, in most provinces, we have access to a basic healthcare plan if we're in retirement, and most full-time positions offer health coverage if you are working. The last one is long-term care protection. Long-term care insurance helps individuals cover the cost of long-term care services such as a nursing home, assisted living facility, or home health care in the event of a chronic illness, disability, or cognitive impairment. Long-term care insurance can help preserve assets and provide financial security for individuals and their families during periods of extended care needs. However, because of the increasing costs of living care in Canada, Most living care policies or long-term care policies are only available as conversion from a disability policy, which provides similar coverage while you're working, or from a critical illness policy on maturity. Before choosing an insurance policy, it's essentially to carefully consider your financial situation, long-term goals, and the needs of your dependents. Consulting with a licensed insurance advisor like me can help you understand your options and make an informed decision. When we're doing your financial planning, we will be reviewing the completeness of your financial plan, and I may suggest using different types of insurance to cover different things. At the end of the day, though, you need to be comfortable with your choices, and questions are always welcome. So let's talk a little bit about term life insurance. It is, like I said, the least confusing of the types. And we have gone over a bunch of the different options. The biggest thing that's changed about term life insurance in the last 10 years is the coverage period. We used to be limited to very specific numbers, 10 years, 20 years, sometimes 30. We saw a term to 100. But recently, companies have started offering completely customizable terms. You can do a term 4 if you want to. You can do a term 23 if you have a mortgage that is expiring in 23 years and that's all you're going to need it to. It is very customizable. Something that doesn't change, though, is the death benefit. If you pass away during the term of the policy, your beneficiaries receive a tax-free lump sum. And it doesn't have to be used for something specific. It can be used for whatever need they want. And this is one of the ways that a personally owned policy differs from creditor insurance, is that your beneficiaries will get to choose how they use that money. They don't have to pay it out to cover a mortgage. They can just continue to cover the mortgage term, and when they're ready, pay off that house. The premiums, the cost of the insurance, is much lower normally than a permanent insurance policy. To keep your policy active, you need to regularly pay your premiums. You can either do that annually, where you'll get a bit of a discount, or monthly. Renewability. When I'm looking at an insurance policy, I'm really looking at what options are involved in that insurance policy. Is it renewable? What if something happens with your health and you're going to need this insurance over the next little while, but you know you're not going to be able to qualify for new life insurance? This allows it to continue on at the end of the term, even with an increased premium. We always talk about it so that you can make an informed decision. Unlike permanent insurance, term life insurance has no cash value. It is very simple, and it means that you can cancel the policy or let the policy lapse, and you don't have to worry that you're going to be losing out on a cash value that you get later on. Term life insurance is generally lower cost than permanent life insurance because it provides coverage for just a specific period of time, and often expires or becomes too expensive to keep for your whole life. When applying for term life insurance, you'll typically need to provide information about your health, lifestyle, and medical history, and possibly undergo a medical. However, it's not always necessary. The insurance company uses this information to determine your eligibility for coverage, but there are options that do not require your medical history. Overall, term life insurance can be a valuable tool for protecting your loved ones financially during specific periods of your life when your death could have significant financial consequences, such as when you have dependents or large outstanding debts. It's important to carefully consider your financial needs and goals when choosing a term length and coverage amount for your policy. Now we're going to go into whole life. So whole life was the very first type of life insurance offered in Canada. And it is often one that people are familiar with, but aren't interested in buying because they have heard it's very expensive and very hard to understand. It's part of this category of permanent insurance that provides coverage for your entire life, as long as your premiums are paid. So, like I just said, covers you for your whole life. Maybe why it's called whole life. There are guaranteed premiums associated with a whole life policy. So you don't have to worry that your premium will go up or change. You have a guarantee that it will remain consistent through the life of the policy. The cash value can be accessed by the policyholder through withdrawals or policy loans, which we are going to get into as we keep going. This guaranteed premium can provide stability and predictability in financial planning, as policyholders know exactly how much they need to pay each month or year and can track the amount of cash that's accumulating inside their policy. A portion of the premiums paid accumulate as a cash value over time, which grows at a guaranteed interest rate that is set by the insurance company. If you do need to withdraw or take a policy loan, it may reduce the death benefit payable, but talking to your advisor can help you make sure that you understand what's going to happen. Tax advantaged growth. The cash value inside a life insurance policy, in this case, a whole life policy, grows tax deferred. It means that you don't pay taxes on the growth as long as it remains inside the policy and would pay out to your beneficiary tax-free. Dividend payments. So this again is kind of what whole life is famous for. Some whole life insurance policies in Canada are participating policies, meaning they are eligible to receive dividends from the insurance company's profits. These dividends can be used to purchase additional coverage, can reduce premiums, or be taken as cash. They are not guaranteed, and they depend on the financial performance of the company. This, I believe, is why people are so concerned about how their insurance company is doing. So the big guy for me is estate planning and legacy planning. Anytime we're talking about permanent insurance, for me, I'm looking at how can we transfer wealth using an insurance policy, and how can we make sure that your beneficiaries and your executor have enough cash to take care of your estate when you're gone. Again, this money can be used for anything. So if you want to leave a ton of money to a charity, you can do that with a permanent whole life policy. The thing about insurance, and especially permanent policies, is they are extremely customizable. You can add on term policy riders where you increase your insurance for a period of time. You can add on a disability rider where you are not going to pay your premiums if you become disabled. You can sometimes add on kids to your insurance policies so that you make sure your children have insurability throughout their lifetimes. It's important as you go through that although whole life requires a higher premium compared to term life, it's because it is permanent coverage and it will accumulate cash. Before purchasing a whole life insurance policy, though, it's important to carefully evaluate your financial goals, your risk tolerance, and your long-term needs to ensure it actually aligns with your overall financial plan. If I believe whole life might be right for you, I will help you understand the nuances of it so that you can make an informed decision. Universal life. So as much as whole life is the one that is sort of the grandfather of permanent life insurance, universal life, I would say, is the one that has the worst reputation. It's another type of permanent life insurance that offers flexibility and is extremely customizable. So unlike whole life, it has a flexibility of premiums. It offers policyholders the ability to pay a higher premium for a shorter period of time and then take that money and invest it inside the policy in something that's guaranteed or in something that's linked to stock markets so that they can increase the payout on their own deaths, or so that they can lower the number of years they have to pay this policy for. This cash value accumulation can be invested in the markets, but because of that, it requires attention. It requires and attention by your advisor. And if you purchase it on your own, an understanding of the fact that this is not a set it and forget it kind of policy like a whole life. Policyholders have the option to allocate your cash among different investment options and guaranteed options. We can look at indexed accounts and even investments that mirror mutual funds. The cash value, again, grows tax deferred. And in some cases, the cash value increases the amount of insurance that pays out. The big difference between universal life and whole life is that universal life is a little bit more transparent about its costs. Whole life wraps everything in one specific payment. Universal life will break it out and say, this is the minimum you need to pay us to keep the policy in force, but this is the maximum you can put in here as an investment option to increase your insurance amount that's going to pay out to your beneficiaries, to offer an alternative investment, or, like I said, to reduce the number of years you have to pay for this policy. But it's important to understand that if you're investing inside your policy, it can fluctuate with markets, just like any other investment. And if it's not being carefully watched, it can actually possibly cause the policy to lapse if the investments are not being properly managed. Policy loans and withdrawals are very similar to whole life, except that with universal life, at some point there will be a cash value that you could just take out without impacting the policy. Withdrawals from both universal life and whole life insurance are taxable, though, in the year that they're taken. So it's important to understand what you're doing before you decide whether you want to take a withdrawal or a loan against your policy value. Again, universal life is super customizable. So we have tons of options in there. Again, you could even add on a rider that includes critical illness or a long-term care benefit. And we could add things, again, like a disability benefit where you don't have to pay for your life insurance if you become disabled. The biggest tax advantage about universal life is that as much money as you can stuff into this policy, as long as this policy has been set up, possibly will pass on to your beneficiaries tax-free under Canadian insurance law. And because of this, often when we're talking about it, we're looking at legacy planning using a permanent policy that has this flexibility. It can be a suitable option for individuals seeking permanent coverage with flexibility in premium payments and death benefits. However, it's essential to carefully consider the policy's features, costs, and investment options before purchasing it. It's also important to understand that if you're going to purchase it, someone needs to be watching it. So, how do I choose life insurance then? So we're going to go through how you and I would normally talk about life insurance and just talk about some of the essentials. So choosing life insurance involves several considerations to ensure that you select a policy that meets your financial needs and goals. Here are some steps to help you choose the right insurance. Assess your needs. Start by evaluating your financial situation, possibly with me, including your income, expenses, debts, assets, and your future financial obligations, but also your goals. Considering factors such as your age, marital status, number of dependents, and existing insurance coverage will help you figure out what's right for you. Because when we're talking about life insurance, we're talking about how we're going to protect your loved ones, not protect you. If we're talking about living benefits, we're protecting both you and your loved ones in an instance of an unexpected event. Understand the types of life insurance. Make sure that you're asking enough questions. I am always happy to answer questions. And I find that in Canada, there are a lot of misconceptions about insurance. I think all of us have had a negative interaction with other kinds of insurance, like car insurance. But this is actually ensuring your ability to make income, make money, your ability to support your family, and to make sure that if you pass away unexpectedly, the people who love you are not left with a big mess. Calculating your coverage amount. I actually use an online calculator, and some of you have definitely seen this. I do recommend, though, if you want to check it out yourself, there are lots of online calculators, but would probably be simpler to just consult with a financial advisor to calculate the appropriate amount of life insurance. These use your outstanding debts, your mortgage balance, if you have children, maybe future education expenses, income replacement needs for your family, funeral expenses, estate costs. And then when you have gone through all of that, you should be comparing. So normally when we do insurance comparisons, we're doing a survey of all of the different insurance companies in Canada. We go through them, and then I look at the different options, right? We're going to evaluate the policy features. We're going to make sure that, is it a term policy? Is it a term that can be convertible to permanent later when you're ready? This is definitely something that lots of people have heard me talk about. Evaluate and make sure that you have the right add-ons and riders. Do you want to add on a disability insurance or a critical illness? Do you want to stop paying your premiums if you have become disabled? Choose a policy that actually aligns with your needs and long-term goals and the right features for you. Make sure you understand how flexible your policy is. In term life insurance, the policy is very inflexible. However, there's no penalty to cancel, and there's no problem if we need to, for example, reduce the amount of life insurance coverage you have. There is nothing stopping us from doing those things. With permanent insurance, we want to look at coverage adjustments, cash value access, and customization options. This one, of course, is a little self-serving. Seek professional advice. I would say this whether or not I was a licensed insurance advisor, but it's definitely better to talk to somebody who knows the differences. I absolutely agree that doing your own research is important, and I would never suggest that you don't do your own research. However, seeking out professional advice can help you to understand things like the fine print. Make sure you have thoroughly reviewed everything. Make sure you understand what's going on in your contract. And if you don't understand, reach out to your advisor, reach out to me and ask questions, and we'll be happy to explain them. The last one is regularly review your coverage. So normally when we are doing reviews, we review your coverage every 2 years. We want to make sure that you understand everything. Especially though, if something has changed in your life. Have you gotten married? Did you buy a new house? Do you have a baby? Did you decide to retire? All of these things are going to change your life insurance and your living benefits needs. By following these steps and conducting thorough research and talking to somebody who is licensed in this field, you can make an informed decision when choosing insurance that provides financial protection and peace of mind for you and your loved ones. Thank you so much for your time and attention. I look forward to having conversations with you to ensure your financial planning is complete. Please let me know if you have any questions. I am not seeing anything pop up in the chat, but that doesn't mean it doesn't exist. If you are having trouble typing or getting the chat box to come up, oh, I've got a question. Can a person customize whole life or universal life? Just going to read it. After the policy has been issued? Yes and no. So can you customize your insurance policies? Yes, you can reduce coverage with no underwriting. You can add on certain things. And certainly with universal life, you can increase or decrease your policy premiums. If you have been overpaying for a while, you can absolutely reduce your premiums for a period of time. And so it gives you that extra flexibility. One of the types of insurance that is not in here is called a variable life. And it was a type of policy that was sold in the early 1990s, and it actually allowed you to add an RRSP into your life insurance policy, which can make things pretty exciting. Any other questions on how to choose insurance or anything else? I think one of the big question marks I hear a lot is how in the world are we going to figure this out? So I use an insurance calculator where I enter all of your information. As you guys know, I love to ask you guys a ton of questions and get a better feel for what's going on in your life. When we're doing insurance planning with young families, specifically, one of the big questions, and I get to be really nosy, is to ask, are you planning for more kids? This is an actual essential question. This is not just me being like, why aren't you married yet? Why don't you have any kids yet? And so as we go through the process, occasionally we come across something where we're like, you know what, I just don't think you need life insurance. Or, you know what, I think you'd be better served with disability insurance coverage right now. Or we may find that you have enough coverage through work. One of the big misconceptions about work life insurance coverage is that it takes time for it to pay out. The standard payout period on a group benefits life policy is 3 to 6 months, and your beneficiaries may need it before that. Same with creditor insurance. You may find that you just needed a little more flexibility. And so something that's personally owned is definitely worth considering. As we work through estate planning, I'm talking to lots of people who have determined that they would like to self-insure, which I think is absolutely fair. And using other insurance products like segregated funds give you the same benefits as life insurance without having to qualify under a medical or pay premiums to a life insurance policy. Does anyone else have any questions? Oh, I got another one. Okay. Can someone use the value inside an insurance to help fund their child's education? Absolutely. Before tax-free savings accounts were around, Universal Life Plans was actually absolutely a place where people were using the cash value and the investment options as an alternative investment for education or for when their kids hit adulthood. Not everybody believes their children are going to go to post-secondary. Not everybody goes to post-secondary immediately. Maybe you start a business, maybe you end up working for someone else and then get into education later. And extra funds inside a life insurance policy absolutely can be used for that. But again, could also be used for business building, could help your child buy their first home. Really, the possibilities are endless because it's not designated for one specific thing. Okay, well, I think that's everything. I hope you all found this informative and a little bit entertaining. I know life insurance and living benefits isn't always exciting. Have a wonderful evening, and thank you for coming.